As traders, we all fall into the same psychological traps and make the same mental mistakes. The first step for breaking the cycle and avoiding counterproductive behavior is to gain an understanding of the trading biases we face. In today's video, I will share a catalog of 5 psychological errors to which traders fall victim and the common biases we should all seek to avoid. Number 1 is the confirmation bias. Confirmation bias is the tendency to search for, interpret, favor, and recall information that support our own decision and assign a lot less weight to information that doesn't. Basically, we tend to believe that which supports our current beliefs and we tend to ignore that which challenges those beliefs. Confirmation bias occurs when you take a position in the market and then focus mainly on the technical indicators or market news that support staying in that position. Any fundamental or technical warning sign is not taken into consideration and the information is squashed. In this example, let's say you analyze the chart and conclude that the price will go up from that point onwards. You will look only for confirmation of a bullish price trend. Every indicator or price pattern you find will be viewed and interpreted to confirm your view. Price should go up. An indication that the price might do the opposite, like this downward breakout, will be mostly ignored. There's a lesson here for all of us. The solution is to seek out and understand information that disagrees with our existing belief and evaluate information as rationally as possible. Number 2 is the self-attribution. Have you ever noticed that you tend to blame external forces when your stops are hit, but never give credit to those same forces when your targets are hit? When we win trades, we want to believe that this is due to our brilliant decision-making skills rather than luck. When we lose, we tend to believe that is due to bad luck, otherwise we'd have to admit that our losses could be due to poor decision-making skills. Picture the scenario: you place a trade on a company, but soon after its stocks began to fall, you then blame the friend who told you about the company, or the post on the Reddit, or even the market itself, or going down. This instinct means you failed to look at a bigger picture because you neglected to take into account market trends or the latest financial updates from the company. For example, now let's reverse the scenario. Say the company is successful and the stock starts to increase. This time you believe you always knew the company would be a good investment. The company's success becomes your success. See the difference, right? In the long run, this self-attribution bias is a negative phenomenon which can lead to skill deficits and failures. Number 3 is the hindsight bias. Have you ever looked at a chart and immediately assumed that you would have known exactly when to enter and exit the trade that occurred in the past? This use of hindsight is very common and it gives you a false sense of confidence in your trading abilities. It's easy to look at the chart and believe we would have known exactly what to do at just the right moment. In hindsight, anyone can see that Bitcoin was about to explode or a stock market crash was imminent. However, things that seemed obvious in hindsight were much less obvious at the moment they occurred. In order to overcome hindsight bias, you have to think in terms of probabilities. The correct trading decisions are actually not based on what happened after you made a decision to enter into a trade. It is based on the probability of what was happening at that moment. You cannot let hindsight bias determine whether a trading decision was correct or not. Number 4, anchoring. This is the name given to the process of focusing on irrelevant numbers in trading terms. The number most likely to fill this role is the entry price of a trade. Many traders care a great deal about the current price versus the entry price, but the latter is irrelevant to the future movement of the price. Mentally anchoring the trade to the entry price can lead to poor trading decisions. For example, imagine that you have bought a stock near the support at $50. The stock then breaks support and falls to a new low at $40. Technically speaking, the stock is now a sell. However, you may be reluctant to exit the position because you wish to break even. You only care about getting out of 50 and thus ignore important information. Basically, you are mentally anchored to the entry price of 50. In reality, the entry price has no bearing on what will happen next. The important information is that the stock has broken support and reached a new major low. The entry price of 50 is now irrelevant. You may care about your entry price, but the market doesn't. The key to overcoming This bias is to be objective and flexible, being able to evaluate prices and make decisions impartially regardless of what your current position is. Number 5. Chasing performance. Traders have a tendency to base future projections on past performance. This leads to a behavior known as chasing performance. It's the feeling when you think you have to double your account by next month, or you are missing out if you don't make a lot of money as soon as possible. This leads to higher risk and large position sizes. How do you explain traders desperately buying at high prices as stock prices continue to rise, or those who buy Bitcoin at very high prices because everyone's talking about it? The formal feeling that you are missing out on great returns has probably led to more bad decisions than any other single factor. Chasing performance simply means you create a false expectation and a sense of overconfidence which can harm you in a long run.